Welcome back, traders. It's December 15th, 2023, and I'm recording this at about 10:40 a.m. on Friday. It's been a big week for the market, so let's dive right into it. Before we do that, let's remind ourselves that the presentation is made by Rain King LLC, and I'm an amateur individual growth stock investor. So here's our agenda. We're going to talk about the indices and put them in the context of the big picture. We'll get into breadth, some accumulation measures that we look at, and then what to do if you're underinvested in this rally so far. And then we will touch upon some of the 2023 picks that I made and looking forward to making picks for 2024. And then we'll wrap up. So let's get into the big picture and look at the indices. Okay, this is a long-term chart looking at the super cycle bull market concept. I refer you to the June 23rd video where I go in great detail about these cycles. So I wanted to put it in context. We are in a super cycle, I believe, that could run from 2009 major low all the way out to 2035. So more information is available in the June video. So here's the S&P 500 as a line chart. And this is going from 2021 to 2023, looking at the last 2 years of the bear market that we've had. Now you'll notice here we are at the 2021 top. We topped right as the Fed was starting their campaign to raise interest rates 525 basis points over the next 16 months. Now what's interesting about this is here we are today. Today, in December of 2023, we are almost at the same level of the old highs of 2 years ago, yet the Fed is positioned to start cutting rates sometime in 2024. So it's an interesting dynamic going on as we approach new highs. And you can also see that the accumulation distribution rating on the S&P is very strong at 1.6. We haven't been that strong going all the way back into some of the bear market rallies we had in late 2021. And then we never returned to it in the bear market. So interesting stuff from a longer term perspective. So here's a chart from All Star Charts. And what this is looking at, here's the S&P, and it's looking at the percentage of stocks that are, quote, overbought. And you can see that the chart is trying to show that we've reached some very extreme readings. It's showing that we're over 40%. Actually 44%, which is an extremely rare overbought reading. It's only occurred really 3 times over the last 20 so years. You can see that it's happening today. It happened back a couple months as we came out of the COVID market in June of 2020 and June of 2023 when we were really coming out of a long, almost 3-year bear market. You can see here's where that signal happened on the extreme overbought here, and here. And what you'll notice is market went a whole lot higher after these readings, which can be contrary to what you might think. Now, Bill O'Neill in his book, How to Make Money in Stocks, if you go to page 231, this is what Bill says. The short-term overbought, oversold indicator has an avid following among several individual technicians and investors. It's a 10-day moving average of advances and declines in the market, but be careful. At the start of a new bull market, the overbought or oversold index can be substantially overbought. This should not be taken as a sign to sell stocks. So the point is, don't get scared about an overbought reading in the beginnings of a new bull market. Something big might just be getting started. So we'll keep this in our back pocket, but I wouldn't get overly concerned. So here's the NASDAQ on a daily chart, daily candles. I tweeted this out this morning. A little device that I use when the index is getting extended is when the distance between the price and the 9 EMA exceeds the distance between the 9 and the 20. When that gets extended, it's kind of like a dog on a leash. Usually the market kind of pulls in. It's not perfect, but it definitely usually gives a good guidance. You can see it happened way back here during the, it triggered multiple days at the July top. And then it also had a little trigger in here, which did lead to some sideways action that had a little downward bias. So it's just a little device I use that says, you know, we could expect a pullback. I expect pullbacks to probably be in the 3 to 5% range if this is really a bull market. So the good news is we're getting a lot of participation. So I wanted to just show some charts that actually show you how much participation we are getting. Here's the industrials. The industrials are at all-time highs, very positive. They're stretched, but really positive, lots of volume. Here is the RSP, which is the equal weighted S&P 500 index. Again, you can see we've gone up 19% in only 33 days, big volume, and we are at new highs, really bullish. Now, if we look at bonds, this is the TLT, which is long-term bonds. You can see as interest rates are forecast to start coming down maybe in 2024, bonds are rallying. And they started rallying way back in November. So big gain, 20%, and it's fueled by this prospect of lower interest rates. In addition to that, we're seeing participation by the small caps. They are ripping higher with multiple gaps along the way with big volume. There certainly is rotation going on into smaller cap names because they are favored during a falling rate environment, starting to give us some fuel for a bull run. Okay, and here's two other really essential ETFs and sectors that are doing well. The SOX on the right was the leading index moving into the July rally. And then the SOX actually led us in the correction down. We had 3 waves down. We corrected almost 19% in the SOX index, but we have roared back and we are actually at all-time highs. It's a good sign for the market when semiconductors are doing well. And probably the leading sector of tech right now is cybersecurity. And you can see it's been a rocket ship up in this rally since the follow-through day, having some exposure to some of the names, either CrowdStrike or Zscaler or Palo Alto, et cetera, probably is essential that you caught one of those to get some real movement in your portfolio. So broad participation, which is really, really positive. Now here's an update on the NASDAQ, looking at a daily chart, just plotting all the breakouts. The good news is obvious. You're seeing breakouts occurring every couple of days. We get a new round of stocks breaking out. But obviously, the ones that break out right around the follow-through day or even before the follow-through day tend to be the leading stocks. So power trend's still on. Lots of good stocks breaking out. And you'll notice that these ones in the light blue, these are actually some of the young gun IPOs that have actually come out in the last 2 years. So these stocks are new names. You might not be familiar with them, but they could go on to put in good leadership runs in this new bull. So breadth and accumulation, let's look at some measures there. So I'm coming back now to the S&P 500 on a line chart. Here's the November 21 top. And then the bottom pane, I'm showing new highs and new lows as of last night. What's important, and it's pretty obvious here if you look closely, we are at the highest level of new highs. Yesterday was 303 since the bear market began in November of 21. So if you draw a line from that high, you draw it all the way across this chart, you can see we have not been at this level in a long time. So it's been over 2 years. So very positive sign. And you can see that it's actually trending up, accelerating up, and the new lows have dried up. So this is exactly what we want to see with broad participation and getting new highs. Now, if we zoom in on the S&P, and this is a daily chart using candles, we've been focusing on breadth in our trend monitor. We started flagging the change in breadth. You can go back to the November 3rd general market update where we're flagging all of these signals that breadth was improving even before we had the follow-through day. So under the surface, things were changing on this last leg down, and we were there. We were all over this, and when we finally got the follow-through day, we started to, again, see positive breadth. We had this big gap up on November 14th where the breadth was extremely positive. We had 10-to-1 advancers over decline, and then we kept following that up. Here's 2.8-to-1. Then we had another big breadth day of 6-to-1 on December 1st. And then this week we've had an 8-to-1 up day on, I believe that was Wednesday, the Fed day. And even yesterday, when the indexes were modest, we saw breadth showing advancers over decliners by 4-to-1. So we're getting confirmation that the market is broadening out. industrials, technology. So we're seeing some great stuff. And these are on days. This breadth measure is looking at, even though the index is not up much, the breadth is outperforming the index, showing us under the surface things are very strong. Because you can see on a day here where the S&P was actually red, we had good breadth. So really positive stuff. Some other measures. This is the New York Advanced Decline line on the left. We talked about this really strong push higher. We're running into a uptrend line to the underside of it. We could get some backing and filling here as we're a little stretched. And then on the right, this is the percentage of S&P stocks that are above the 50-day moving average. This has gotten really hot. We were over 90% on Wednesday. So this could pause and start to digest. It's not a place to be chasing extended stocks or initiating new positions in stocks. So some of these measures are strong, but they're telling us things are running a little hot, and we probably are going to pull in a bit. So one of the things looking at when you're looking at leadership is, one way to do it is to look at institutional accumulation. And one sign is, and Bill talks about this many times at seminars in his book, when you get 5 weeks up in a row or more, that's a real sign of institutional accumulation. You can see it on the charts. It's basically institutions are continually buying for week after week after week. You can see here it's Uber. Look at the institutional buying. Now, this buying is not anticipating a quick trade that the institutions are going to dump. It means they're building positions that they're going to hold for 1, 2, 3, 5 years because they believe Uber valuation is worth more. Chipotle, 7 weeks up in a row. And CrowdStrike, one of the big leaders of the market right now, is up 6 weeks in a row, trying to make it 7 with a good close today. I will disclose that I have a position in CrowdStrike that I've had since I mentioned that as my power pick at Blue Sky. Other names you might want to take a look at that are showing this trait is Snow is up 6 weeks, GitLab 6 weeks, MDB, DraftKings, Nutanix, all showing consistent buying by institutions. Other things you can look at for institutional accumulation would be weekly closes at the peak, tight closes week to week, blue spikes of big volume, and check out the sponsorship. When you get 3 quarters in a row of increasing mutual fund sponsorship, where you go maybe from 200 to 250 to 300, very positive sign of some institutional accumulation. So important to see these signs. They're on the charts. So let's talk about what to do if you're underinvested in the rally, because this can be challenging to answer this question. Now, if you were timid or you hesitated to buy around the follow-through day because you were scared, or maybe you were just watching the news in November, you're probably underinvested. Did you miss the big leaders? Some of you might have missed the big leaders, but you're thinking right now, well, I'll wait for my favorite name or my favorite story to finally break out. And you may be thinking of names such as Tesla, NVIDIA, SMCI, etc. These are stocks that did well during the year, but they're either still in basis or they're lagging in this rally. So if you think you're just going to wait for them to break out, I would really suggest you think again. And the reason I ask you to think again is the leading stocks, the leaders, go up the most and they give back the least. And as a position trader, I would suggest always go for the leader and not take second and third tier names. Second and third tier names are just laggards. And though you may love the Tesla story, you may love the NVIDIA story, at the moment, they are laggards. They're in bases. They haven't even broken out yet. And some of them don't show strong accumulation. So, get rid of your bias just because you like the company or like the product. We need to target the leaders. So no FOMO. We don't want to be chasing any extended stocks, and the leaders are extended, so don't be chasing them. But what that means is you really need to exercise patience and discipline. You got to wait. That means I think you're much more savvy if you can have patience and discipline to wait and stalk a pullback entry or a new base consolidation in the leaders versus taking these second and third-tier names, which can be enticing if you're underinvested. This takes a lot of work to be disciplined. Remember, the true market leaders that we're talking about are either number one or number two in their field. Their industry group is probably in the top 40 and rising in the rankings. And I mentioned before, mutual fund sponsorship is probably growing at least 2 or 3 quarters in a row. These true market leaders tend to have good liquidity, and that would be at least 20 million average daily volume per day, preferred more for real liquid leaders. They're showing great relative strength lines. They're showing great price action. So that's what we're talking about. And you need to be trying to find a way in if you missed any. And if you are in these, you can look for ways to add and get a bigger position. So 2023, 2024 outlook we'll look at next. So I made picks last year on December 26th of 2022. I made these picks and I grouped them into cyclical, growth, and speculative plays. And I've been tracking this every quarter. And these picks I cannot change all year. The rule was I made the picks on what I knew, looking ahead 12 months. And so I've stayed with it. And you'll see here's the performance each quarter. And here's where we are as of yesterday. So undoubtedly, there's been a few duds. Probably the biggest dud and disappointment has been Enphase, Pod, with all of these new obesity drugs. Impinj has not performed. But at the same time, I found some big winners. My biggest winner right now in these picks was SMCI. Shop has been a big performer, triple-digit gain. You can see that Celsius was on our radar, as well as the housing stocks. I had DH Horton, and it's up almost 72%. So pretty decent performance over those picks, even though there are going to be some duds. So where are we going with this? I'm going to make picks for 2024. And I'm going to share my market outlook for 2024, and I'll probably do that towards the end of December or maybe even next week. So we'll look for that as we go forward. Okay, one other thing I wanted to mention was I've put together a 2024 market diary calendar. And this calendar is all about market events and market wisdoms and data. There are every day of the trading year, and it shows quotes from famous people. It shows interesting data from some of the market cycles, shows what's going on, what happened in history on certain dates. And I've also included a lot of research excerpts from studies that I've done on model book stocks and showing you some of the graphs and some really interesting data. So it's a pretty interesting little document. If you were a Blue Sky Early Bird member, you actually got a free copy of this, the PDF. But if you didn't, and you're just finding about this now, it could make a nice gift, or it might be a great thing on your desk as we go through 2024. If you're interested in this at all, send $15 to my PayPal account. This is the account. If you need any more information, just email me at rainKingBullBear@gmail.com. So let's wrap up. It's been a really interesting week, a strong week for the market, but the markets are clearly extended. That being said, these overbought readings early in a bull market can stay overbought much longer than you think. So keep that in mind. You should have a toehold in some of the leading stocks and you're building gains. If you haven't and you're underinvested, don't chase extended stocks. Now, at this stage in the rally, average cost becomes very, very important, and you're actually faced with a dilemma. You say to yourself, well, I want to protect some of these unrealized gains, but I also want to give some room for normal fluctuations. Very difficult to say, what do I do? If you move your stop too quickly, you might get stopped out and lose your whole position that you worked hard to obtain. But if you keep your stop way too loose and we get a sharp down day or a sharp correction for a few days, it can wipe away a lot of your profits. So this is something you want to look at your average cost carefully, and you want to rank your stocks to make sure you understand which one of your stocks is number one and which one is number 2, 3, and 4. So this whole thing that topic that I'm really just teeing up is all about the subtleties of portfolio management. More than we can cover in a short video like this, but I may cover it in a longer video at some point. But a couple of things to consider. You might want to consider selling your slower moving stocks and bank some of the gains. If you have gains of 10, 15, 20%, and we think we're going to pull in a little bit, you might want to bank some gains to build on your account in order to keep the big leader that you want to play out for a bigger move. Now, if you have the big leader or one of the big leaders, you probably want to give it a little bit of room. And this is all discretionary. Maybe the 20 EMA is a place that you give it room to. You want to find a way of how you can add to further build that position that you want to take advantage of for a bigger gain. Now, Bill would always stress that you can make many smaller mistakes on average stocks, but you don't want to screw up the big leader. The big leader, if you have the big leader, you should be looking how to force feed it with more money appropriately with controlling risk. It can really move the needle on your portfolio if you can build size properly and handle the stock properly and not get shaken out. So exposure levels, I think, expanded this week. 75 to 80% seems about right to me. I think we're getting continued positive feedback, but being so stretched, I don't think you want to be putting new work together right now. I do want to keep some powder dry for the pullback to add to some of the leading names. So the quote of the week is from the GOAT, William O'Neill. Your objective in the market is to make big money when you're right. And this goes to what we just talked about on the last slide. If you believe that you have one of the big leaders of the market right now, you should try to leverage that and actually make, quote, big money by getting more money into that position, building the position while controlling your risk and trying to play it out as a true market leader. And those stocks we know usually can make a move of 12 to 18 months. So some words to really, really take note of. So that's all the time I have for now. It's December 15th, and that's the general market update. Have a great weekend, everybody, and we'll see you all next week.